You know, it's funny. When a company that sells something as fundamental as paint puts out its earnings, it can actually tell you a ton about the health of the economy. So today, we're going to unpack the latest results from Sherwin-Williams, and we're going to see how they're, well, painting a picture of resilience in what is a very tough market.
Okay, right off the bat, here's the headline number that really got everyone talking. Despite this super challenging economic backdrop, Sherwin-Williams delivered a solid 6.5% increase in adjusted earnings per share. I mean, that's a huge win for their shareholders, right? And it immediately makes you ask the question, how in the world did they pull this off?
All right, to answer that, we've got to look at the scoreboard first. So let's quickly run through the key numbers that really show just how surprisingly strong this quarter was. So what's really interesting here is just how consistent everything is. I mean, look across the board. Consolidated sales, up over 3%. Adjusted earnings per share, we just saw that, up a whopping 6.5%. And then there's this key profitability metric, adjusted EBITDA, which, is basically just a fancy way of saying earnings before all the accounting stuff like interest and taxes. That was up a really healthy 6%. So think about it. They're not just selling more stuff, they're actually getting more profitable while doing it. And that really sets the stage for the real story.
Yeah, because this kind of growth definitely didn't happen in a vacuum. The company is staring down a pretty significant headwind, an economic reality they're calling softer for longer. And honestly, this is the central conflict in our story today.
So what does softer for longer even mean? Well, it's basically this nagging, persistent state of weak customer demand. It's not like a sharp, quick recession that's over and done with. Nope. It's more of a prolonged, sluggish period where there's no clear end in sight. You could almost think of it like an economic marathon, not a sprint.
And listen, this isn't just some fancy analyst speak. These are the exact words from the CEO, Heidi Petz. That word she uses, choppy, that's the key right there. It just means unpredictable. And when she says across every one of our end markets, that tells you this isn't some small, isolated problem. It's everywhere.
So, okay, given that whole choppy environment, how did the different parts of the company actually do? Let's break it down, because what we're really looking at here is a tale of three very different businesses. First up, we've got the star of the show, the Paint Stores Group, or PSG. Now, this is their main business, the one that serves all the professional contractors. And wow, just look at these numbers. Sales are up over 5%, and profit is up 6.5%. I mean, in this economy, that is an absolutely stellar performance. It's crystal clear evidence they are just blowing past the rest of the market. And this slide right here just brilliantly illustrates how much they're outperforming. It's kind of nuts, actually. On the one hand, their residential repaint business grew by mid-single digits. Great! But on the other hand, the overall market for existing home sales, a huge driver for painting, was in the red. It was negative almost every single month. So how is that even possible? Well, the only way you bridge a gap like that is by aggressively snatching up market share from your competitors.
Okay, next up is the Consumer Brands Group. This is the stuff you and I buy, the do-it-yourself paint you get from retail stores. And here, you can see that economic softness a lot more clearly. Sales and profit are both down just a little bit. But, and this is a big but, this was actually better than anyone expected. And that tiny dip in profit, it shows they did a fantastic job of keeping their costs in check.
And finally, we've got the Performance Coatings Group. Think of this as the heavy-duty industrial stuff. And this one, well, it was a real mixed bag. Sales were up a little, which is good. That was mostly driven by strong demand for things like the coatings on soda cans and paint for car repairs. But their profit was down, and that was because of weakness in other industrial areas and, just selling a less profitable mix of products.
So when you put all that together, this varied performance basically forced the company into this really fascinating dual strategy. It's like they're trying to do two totally opposite things at once, making some really tough calls on cutting costs, while at the exact same time placing some huge bets on future growth. It's a true balancing act.
Okay, so on the cost control side of things, they made a really tough decision. They decided to temporarily pause the company's 401k match. Now, the CEO was very, very clear that this was not a decision they took lightly. As you can see from her quote, the thinking was basically this: let's do this painful thing now to preserve as many jobs as possible to weather this storm while still being able to fund those important investments that face the customer.
And speaking of those investments, wow, they are not small. While they're tightening the belt in one area, they are aggressively, and I mean aggressively, expanding in others.
We're talking about opening up to 100 new stores, hiring a bunch of new sales reps to go with them, making a major acquisition in Brazil, and moving into a brand new world-class global headquarters. This is not a company that's playing defense.
All right, so that brings us to the future. We know this softer for longer environment is probably going to stick around. So what's the game plan for 2026?
Well, the main challenge is still the same, right? That economic choppiness isn't just going to disappear. And on top of that, their own costs are expected to go up. So the really crucial question is, how are they going to fight back?
Let's actually visualize the problem here. They're forecasting some modest increases in things like raw materials and wages. Okay, manageable. But just look at that middle bar. That's a significant spike in healthcare costs. We're talking low double digits, like 10, 11, 12%. That is a major financial headwind that they have to offset somehow.
And here's their primary weapon. Bam! A 7% price increase for their largest and most successful division, the Paint Stores Group. Now that is a bold move. It shows an incredible amount of confidence in their market position and in the value they give to their pro customers. It basically says, yeah, our costs are going up, and we're confident enough to pass those costs along.
So as we wrap this all up, it really comes down to this single, provocative question, doesn't it? Sherwin-Williams is staring down a shaky economy, and they're not retreating. They're doing three things at once. They're cutting costs where they have to, they're investing heavily in growth, and they're flexing their muscles with pricing power. It is a super high-stakes strategy, and it really makes you wonder, in today's world, is going on offense the best and maybe even the only defense?